Good. It's 11 o'clock. We all should get going, I think. So our guest this week is Ian Nance, who's the manager of Temple Bar, one of them. And I've got a bit of news to cover first, but not a lot. Obviously, it's been August. There's not a lot going on in the markets. There's just a couple of renewables bits to look at. JLEN first. As you see with both of these charts, the NAV detaches from the share price around the time that interest rates start going up. And there may be a tentative sign that things are improving as now interest rates are starting to go down in the UK, but that discount is still too wide. So about sort of 17% is too wide, and the board is not comfortable with that. Because the discount is so wide, the yield is pushed up, and that's now over 8%. And I think that's pretty attractive, really, considering it's also got some inflation linkage in its revenues. So if we go back to June, it put out results and the NAV was impacted. So you can see that down there, it's fallen by 7.7%. You see it's been ticking off a bit. Really, what's been doing is giving back the benefit of higher power prices. And those have fallen back again. They've fallen back slightly faster than people thought they might do. And that's hit the NAV. And also the impact of higher interest rates has pushed up the discount rates that are used to value the future cash flows of the portfolio to work out the NAV. So that took off another 5p. So that's the main impact, really, negatively. But in terms of the revenue and cash flows, still really unaffected, and they're comfortable to raise the dividend by 6% last year and 3% for the current year. Nevertheless, because there's a wide discount, they said, well, we've got to do something about this. We've got a discontinuation vote that's kind of built into the structure. So that will happen at September AGM. I'm extremely surprised if that amounted to anything. We've just had one with Next Energy, and it was only sort of like less than 5% against continuation. So I think it'd be much the same thing there. The main thing with these things is always to remember to vote the right way around. And most of the votes that seem to be in favour of discontinuation, I think, are people thinking they're for continuation by mistake. And that's an unfortunate thing with these structures, but there we go. They've also decided that JLEN is obviously a bit of an anachronism. It goes back to John Lang, which disappeared ages ago. So it's going to be renamed Foresight Environmental Infrastructure with a new ticker to sort of maximise the marketing and the Foresight brand. They're going to cut the fee. It's only marginal, but still, it's a step in the right direction. And they're also going to be much more selective about what they do in terms of new investment activity. So they're going to recycle more from portfolio, recognizing that they can't issue new shares, and use the cash that they raise to pay down the debt, buy back shares, and then if there's anything left over, then there's room for new investments, which is much the same as other renewable firms are saying. So what they've done this week is they've sold just over half of stake in 6 anaerobic digestion plants, AD plants, to Future Biogas. Future Biogas is a firm that's backed by 3i Infrastructure, and 3i Infrastructure put up some of the money for this. It's a decent sized portfolio, so 38 megawatts there, over 300 gigawatt hours of gas output. Future Biogas knows all of these things very well because obviously they were the developer of 5 out of 6 of them, and they operate all of them anyway. So all this is just really sort of transfer, freeing up some money from JLEN, but also it gives Future Biogas more of an incentive to try and ramp up the revenues on these plants. And so that's going to be its main job now with these. They've got renewable heat incentive subsidies and feed-in tariffs on the electricity if they generate that. But the RHI subsidies run for 20 years, and those plants were started operating in 2013, 2016. So those are until 2033, 36, and they're going to try and extend the lives of those plants beyond the end of the subsidy life. And they think they can do it because they've already got a subsidy-free project which is being built, which the off-taker of which is AstraZeneca. So I think they're figuring that if that can make that one work, then they can retrofit these things to make it all of them work. In subsidy post-subsidy environment. Obviously, the NAVs for JLEN aren't pricing any of that in there. So whatever they manage to do on this front will actually benefit the JLEN NAV. As far as 3R infrastructure goes, so I was going to say they're putting up some of the money. This is turning future biogas into more of a disposable investment for them, which is obviously going to help their NAV too. So they freed up, JLEN has freed up £68 million from this disposal. It's still got the stake in the ongoing stuff. It's still got 3 other AD plants that owns outright. So it's definitely not coming out of this part of the portfolio completely. It's going to use most of that money to pay down the revolving credit facility, which was about £160 million at the end of March. So it might be slightly lower than that now anyway. That makes sense. Even though interest rates are starting to tick down, they're still paying 2.1% over the base rate, over the SONIA. So it's only marginal that they're making a profit on these things. So with their finance with the revolving credit facility, so it all makes sense to do this. And they've also launched a £20 million share buyback program, which isn't massive in the great scheme of things, but a lot of other funds are buying back shares too. And the cumulative effect of these, I think, might help shift the dial a bit in the right direction. But obviously what we really need is a resolution to the cost disclosure issues so that wealth managers and IFAs and others can come back and buy these funds again. And hopefully that will happen soon, but seeing is believing. Downing, very similar sort of story in terms of the share price. Different story in terms of the NAV. Its NAV, as you can see, there's sort of carried on marching up. I mean, I know it sort of goes up and down a bit, but that's the nature of what it's doing. It's trying to invest in NAV accretive projects as well as things that chuck off decent levels of income. It's not getting any credit for this at all. Its discount is much wider than JLEN, it's about 35%. Part of the reason for that might be because it's on a lower yield, but that lower yield reflects the fact that it's focused on trying to drive its NAV up. I just think this is massively underpriced, but there we go. What they've said this week is that they bought a shunt reactor, and don't ask me to explain again what a shunt reactor does, but it's complicated, but it's helping again to keep the grid going. So they've upgraded the contract that they've got for that asset with the National Grid, and that adds about 30% to the revenue that they were expecting to receive from that asset. So that will be reflected in the NAV for that asset too. So I think you should expect an uplift from that. And then the other bit of good news is that it's been talking for ages that it wants to get its hydropower plants operating in the Swedish grid balancing market, the frequency determinant market, which is basically about releasing power into the system when it's missing because the wind's not blowing. They've got a lot of wind farms, so they can balance that off. They've got complete control over the flows of water within the dams, so they can have very long-term energy storage through the hydropower plants. So that's potentially quite lucrative for them. Getting one licensed and operating is great news, and then just going to roll that out across the portfolio. So the second one now, the application's in with the regulator, and hopefully that will happen quite quickly. So we should see a series of these announcements as they move forward. So that's all I wanted to say.